Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hi guys, this is Aditya Vora here. Let me take this opportunity to wish all of you a very happy Diwali and a prosperous new year. May your portfolios reach all-time highs by the time we have the next Diwali. So, as per the Diwali tradition, the so-called market experts come on television and give their Diwali dhamaka or Diwali fataka stocks. Your mainstream English business channels, that is CNBC TV18 and ET Now, along with the Hindi channels, which is Zee Business, CNBC Awaz, and ET Now Swadesh, will be roaring to give you Diwali picks. So, if you do the maths, there are 5 mainstream channels, 2 English and 3 Hindi. And even if every channel calls 3 guests and every guest picks 3 stock, you have 45 stock picks to buy from this Diwali up to next Diwali. When I told this to my friend who gets fascinated by people coming on television, his dilemma was which channel to follow and which expert's advice to be relied on. My only answer to that was jisko jispe shraddha ho. So if everyone is recommending stocks to buy this Diwali, why not evaluate stocks which are way expensive and give a sell call? Have you heard of any of these so-called market experts give sell calls on Diwali? So friends, this Diwali, looking at the global setup, along with India's outperformance against major global economies, I thought why not give a list of sectors which are A, expensive, and B, have passed their peak performance at least for the short and the medium term. After all, in my opinion, the difficult part is selling stocks and not buying. Notional profit is good for the ego, but actual cash profit is what you take home, the real deal. So before I list out the sectors to avoid this Diwali, let me tell you a story which my father told me during one of the Diwalis. As a young kid, every time during Muhurat trading on the Diwali day, I always used to ask my father, who was an active investor, which stock should I buy? After all, as a kid, even I was enamored by the so-called Diwali picks. During one of the Diwalis, he quietly told me, sell one of your stocks which you have bought in the past. My immediate reaction was, why would you sell stocks on the Muhurat Diwali day? Everyone buys, right? To which he replied, when you sell a stock, the stock goes from your demat account and money, that is Lakshmi ji, comes to your house. And that is precisely the meaning of Dhanteras and Diwali, where Goddess Lakshmi should come to your house on that auspicious day and not go out. I couldn't agree more with that logic. So I thought to myself, this Diwali, let me tell you 2 sectors which are overvalued and should be avoided till valuations moderate. Logically, if you run a screener on Equity Master's website, by filtering price to earnings ratio or price to book ratio as a parameter, I am sure you will get a list of most expensive stocks. However, this is a historical analysis. The projection of future growth prospects is very important. So, friends, to start with, the first sector to avoid, in my view, is the metal sector. In one line, if I have to describe this thing, the best is behind for the metal sector. Let me give you 3 reasons why you should stay away from the metal sector. A. The only way you can control inflation is to bring commodity prices down. There is no other way central banks can control inflation. Whether you use a car or a pin or drink a can of Pepsi or buy a washing machine or a refrigerator or an AC, the pricing of all of that depends on the price of copper, aluminium and steel amongst other metals. The commodity costs account for more than 60% of the total cost of any product mentioned above. Now, the second point is, with talks of recession in major part of the globe, prices of steel, copper and aluminium, which are globally linked, are expected to see a downside. The problem is that over the past 2 years, since COVID lows, If you take, say, steel as an example, the prices have gone up by 3 times. In fact, even after a 50% fall from the top, HRC steel prices are still 30% above their pre-COVID levels. At a time when the withdrawing liquidity is the priority, there is no way steel aluminum prices can go up meaningfully. Now, the third point is, a lot of steel and aluminum companies have done capex as the cycle had turned with supply constraints over the past. Now, with pressure on prices and higher supply, tough times are ahead for these commodity players. The problem with the metal sector is that it is more of a trading play and you need to be a master at timing the entry and exit. The right time to buy was when the prices were depressed, demand was weak, and valuations were very high, as there were no earnings. This was till mid 2020 or say December 2020. Post that, it was the time to sit back and relax. The right time to sell, or what they call the top, was at the start of 2022. I am sure it is extremely difficult to exit at the top, but then that is how the commodity cycle plays out. The situation which we are in now is not a time to buy. In fact, with every rise, people who missed out on selling close to the peak should exit. This is one sector you should avoid for the next 1 year at least. I expect stocks like Tata Steel, JSW Steel, SAIL, Vedanta, and Hindalco to underperform from here. A lot of people will look at the price to earnings multiple and say that they are still in single digits. I agree, but the price multiples look optically cheaper as you are viewing it from earnings which have tripled and quadrupled. PEs are always cheap when the earnings are at the peak. Going forward, when earnings moderate, PEs will rise, making metal stock look expensive. So that was the metal sector. Now the second sector, which is overvalued in my view, is the footwear sector. I am sure you would be amazed by this when I tell you about the footwear sector. After all, everybody talks about it and it is consensus. But in my view, it is a time to avoid. Just like in 2021, people were gung-ho over the diagnostic space. Companies in that sector were trading at 70-80 times price to earnings multiple, and people still justify those insane valuations. I am sure we all know what happened after that. I see a similar story playing out in footwear stocks like Campus, Liberty, and Metro. Let me give you a food for thought. The world's largest shoe retailer, which is Nike, trades at a price to earnings multiple of 24 times. I'm sure a lot of people will tell me that India is a growing market and markets like USA and Europe are mature where growth is stagnant. The counter to that is two things. Nike is a global player. If developing and fast growing countries like India grow, Nike too benefits. Apart from that, while volume growth from USA and Europe will be much lower than India and other developing countries, the per unit selling price, or what we call is realization, is at least 3 times higher than what developing countries have. Also, USA and Europe don't have unorganized players selling shoes. Unlike India, where the entry barriers to shoemakers which a Liberty or a Campus Footwear or Metro brand sell are non-existent. Basically, these brands have no loyalty unlike Nike. You sell cheap, you get volume growth. So in that case, why should I pay 70 times or 80 times multiple, and in some cases certain companies are barely break even to play the footwear sector? If you look at the table below, with valuations, and even if you multiply the earnings by say 2.5 times in the next 2 years, the numbers still look expensive. As an example, let's take Campus Activewear. Now, Campus did an EPS of 4.1 in FY22. You must also realize that a lot of revenue in FY22 was pent-up demand as schools opened after a gap of 1 year. Even if in FY22, say EPS triples, we are talking about a 12 rupees earnings. Now on a 600 rupee stock and earnings tripling, which in my view is extremely far-fetched, trust me, it is not likely to happen. The stock still trades at a 50 to 55 times 2 years forward. You can't buy a sector at these valuations which have 85% share of unorganized players. Yes, these top 4 to 5 players only control 15% of the total footwear market, while the 85% remaining share is controlled by unorganized players. There is limited moat, with competition being extremely high. While the long-term story is strong on a premiumization and penetration perspective, but at these valuations, you cannot buy into it. In fact, most footwear stocks have doubled over the past 6 months. Further rally should be used to exit. The story looks great, but not at these valuations, at lower valuations. Maybe say a 30% correction. So friends, net, I believe that the footwear sector is a sell on rise while the metal sector is a completely avoid. I am sure you have plenty of brokerages and TV channels to follow this Diwali on what to buy. Now after watching this video, you have at least someone telling you what to avoid or what to sell during this Diwali. Thank you for watching my video and do let me know your thoughts. Happy Diwali once again and have a prosperous new year ahead. Thank you.